Who can provide this trust and a trustless system that blockchains are often referred to as? Well, the answer should be reputable auditors, right? This is what we've been doing for 5,000, 6,000 years, is presenting financial information to the public in a digestible, understandable, and accurate manner. So let's dive into some of those opportunities of what you might be able to do today if you're diving into the space. Citi has estimated that the number of tokenized assets will reach between 4 and 5 trillion by 2024. The World Economic Forum predicts 10 trillion of assets to be tokenized by 2027. Boston Consulting Group forecasts a whopping 16 trillion by 2030. The trend is clear. The future of finance is on blockchains. But with this on-chain future comes its own set of new and unique challenges. As the world moves on-chain, so too will the need for auditors and accountants. So today, we're going to learn about tokenized assets and the opportunity for auditors and accountants in a tokenized future. Today, we'll talk about what are tokenized assets and how are they created. We'll talk about the transparency and reporting challenges presented by these tokenized assets. Then we'll talk about our role as auditors and accountants and what role can we play in solving these challenges. But before we dive in, a brief background on myself. My name is Jeremy Now. I'm a CPA by trade. I'm proud to call Florida my home and the domicile to our certified public accounting firm. I work and I'm a partner at the Network Firm LLP. We're a full service firm that focuses and specializes on the digital asset industry. I'm an audit partner here, but I also act as a product manager for a suite of digital asset crypto audit tools called Ledger. So other firms can service the digital asset industry. Additionally, I'm also part of the AICPA's working group on digital assets. So before we talk about tokenized assets, we need to start with a couple baseline fundamentals. And we have to start with what are blockchains. But I don't want to give a whole nother what is a blockchain course, but I do want to provide a mental model of what blockchains are and how they're relevant for us as auditors and accountants. Now, many of us can get lost in abstract terms like decentralization or consensus mechanisms, but for us, that's not what we mostly need to worry about. So what do we actually need to worry about as auditors and accountants? Well, the first thing that we need to understand is that blockchains are databases of user accounts. They are literally just tracking account balances, debits, credits, and related activities, almost like your Venmo account, right? When you log into Venmo, you can see your account balance, you can see your history of transactions. The next core component to understand is that while Venmo tracks US dollar balances, blockchains can track other different types of asset balances, right? We call these tokens. And we'll get into the details of what that means practically. But it's not just USD. You can think of Venmo. It's almost like Robinhood, right? Where Robinhood tracks your USD balance, but it also tracks your Google stock balance, maybe your gold position balance, your index funds, etc. Right? It tracks different types of assets. And lastly, it tracks the debits and credits of these tokens to each account balance on this database. So hopefully this is starting to ring some alarm bells in your head. At their core, what blockchains are is that they're accounting ledgers. And this is why accountants and auditors need to understand blockchains, because blockchains are fundamentally an accounting technique. So let's make this example a little bit more real, just because seeing is believing. So we talked about Venmo, right, where you have your account, right? Grace in this example, right? She has an account balance. Now she can have crypto too, which is interesting. But she has an account balance. And the same thing is for blockchains. So what we're looking at here on the right side is the equivalent of a user, which is this address here, right? They don't say Grace Hamilton because all this information is public. So we don't want to say Grace Hamilton publicly. but we want to show a representation that will be safe to be shared publicly. So that's what this is called a public address is. And for each of these public addresses, we can see the balance, right? In this case, we have a 0.04 ETH balance. And you'll see below, it says token holdings. This address doesn't have any other token holdings. But when I talk about the fact that it can track multiple types of assets, this is where you would see those balances. Next, we talked about debits and credits. Well, on Venmo, of course, you can see debits and credits to your own account, right? Such as Grace just charged Judy, right? And she has a debit or crediting of $75 to her account. That's great. The same thing relates to blockchain transactions, right? And related to this account. So you'll see this account here, OXE4. Well, you can see the transaction history for OXE4 down below, right? You can see it started with an inflow of 0.009 ETH, then an outflow, then an inflow, then an inflow, right? We can see the debits and credits all related to this account. However, one of the unique considerations is that, of course, this Venmo balance related to Grace can only be seen by Grace. However, this account balance related to OXE4 can be seen by anyone, as long as they just know your address. And what we're looking at here is that we're looking at this tool where I got these screenshots from is from a tool called Etherscan. And it's a public website, free to use. And anyone can go and look at this balance. I invite you to go check out OXE4. If you want to write out those digits, you'll see the same things that I do. Right? All of these transactions are publicly available. All right. So we talked about what are blockchains, right? They're just accounting ledgers that track debits and credits to specific accounts. That enables us to move on to the next topic that builds upon that, and that's tokenized assets. Right? That's the main subject matter. So what are tokenized assets at their core? Well, tokenized assets are digital representation of a real-world asset that's tracked on a blockchain. And we'll dive into that in detail. But the key is that tokenized assets are digital representations of a real-world asset. So if I make a digital representation of my house and put it on a blockchain, there's this tokenized or digital version, but there's also still the real house in the real world, right? So there's inherently these two sides of the equation, the digital and the physical, or the on-chain and off-chain. As mentioned, right, these tokenized assets usually have a real-world counterpart. Now, I gave the example of a house, but that's the case with stocks, right? You might have a tokenized stock, and there's a real-world stock certificate somewhere. You might have a tokenized car, right? It's a digital representation, but then you have a real car somewhere in the real world. So there are these two sides that are inherent to a tokenized asset. Now, ideally, and oftentimes, these tokenized assets are redeemable for the underlying real asset with the issuer. So someone who's tokenizing a house, for example, let's say I go buy that token, right? I should be able to go to that issuer and say, hey, I own this house, here's the token, give me the real house, right? And we'll talk about how that works practically. And it's important to understand that the issuer of these assets is typically responsible for keeping the underlying real world assets safe and available to be redeemed for. So we'll talk about the mechanics of how this works, the risks, and the opportunity it is for us to be able to solve those challenges. But before we do that, let's make this example a little bit realer with the most popular type of tokenized asset today. The most popular tokenized asset today are tokenized dollars. Other people, or they're more familiarly known as stablecoins. Other people call them crypto dollars, but these have become quite popular. The most popular ones are USDC, which is issued by Circle, Tether, and most recently, PayPal came out with their own stablecoin. Now, these stablecoins have been mostly popular, or they started being popular with kind of crypto native circles, if you will, who were using decentralized finance and digital assets, that were kind of deep into the technology. But more recently, these stablecoins have become very popular for those in emerging markets, like in Latin America or Africa, especially places where their currencies are not reliable or are subject to a lot of inflation. So what they'll do is instead of holding pesos or other currencies that might be inflating at a high rate, they'll hold dollars because they hold their value more via this vehicle of stablecoin. So how does this actually work, right? How can you get your hands on some of these tokenized dollars? Well, let's just go through an example. Let's say you want 100 USDC, the most popular stablecoin, the second most, I guess, actually, behind Tether. But let's say you want 100 USDC. What you'll do is that you'll open up an account with the issuer, Circle in this case, and you'll send them 100 US dollars. You'll send it from your bank account to their bank account, right? They'll give you wiring instructions, and you'll send it directly to them after giving them your information. They will hold the USD for safekeeping in their vault, in their own bank account. And then what they'll do is they'll essentially create or mint USDC on a blockchain and send you that tokenized version of that dollar. So this is the process of typically the minting of stable coins. We'll go into how some of the other nuances of this, but this is how you would get some stable coins, get your hands on stable coins. There's other ways where you can buy them on the open market, but as we talk about the minting and burning and minting and redeeming of stable coins, this is generally how it works. But you might be thinking, well, that's great. I have some USDC on the Ethereum blockchain. Well, why do I even care? Why would I even tokenize assets in the first place? Well, there are some benefits that are unique when you tokenize assets. We don't see it as much with the tokenized dollar use case, but for other different assets, think about real estate, the cost to enter the market is really high. And if you can fractionalize that ownership, let's say you could fractionalize a house or an apartment building in New York City by 1 million shares. Now, instead of costing $100 million to get exposure to a New York City apartment building, now you could spend $100 and get a share of that apartment building. So tokenization opens up the opportunity for access in owning smaller shares of different types of assets. Next, there's no market, there's no NASDAQ or New York Stock Exchange for these tokenized assets generally. They're tradable on blockchains and decentralized finance applications. The unique part about that is that blockchains don't close. So if you want to buy or sell or trade, you can do it at any time, any day. There's no weekends. It's 24/7. You can send them or trade with anyone around the world. Right? There's typically no access restrictions on these blockchains. Next, the record keeping on blockchains is oftentimes just better, right? The record keeping on these chains is public, right? So that's good in some ways. It's also bad to maintain your privacy, but everyone can audit the circulating supply of shares issued or tokenized versions of assets or tokenized dollars issued. Anyone can see the total supply on these chains. Additionally, blockchains are generally pretty accurate, right? For the reliable blockchains, there haven't been too many issues, right, with record keeping. So blockchains can be a good store of information. And lastly, it opens up new business models, right? There's this whole movement of decentralized finance. There are entrepreneurs taking advantage of all different types of markets, global markets, new liquidity, new business models using programmability in blockchains. So that's why often people tokenize as well. And that's why we're seeing the likes of Wisdom Tree, BlackRock, Franklin Templeton, all these different types of huge issuers starting to tokenize assets on public blockchain. Overall, as we talked about, the trend is that finance is moving on chain for the reasons noted above. So let's talk about some of the most popular use cases today. We went over the most popular use case, which is tokenized dollars. There's about 170 billion in issuance as of the end of August this year. But there's becoming more and more use cases of tokenization. The next most popular, and what I actually foresee to be growing more and more, is tokenized treasuries or government debt. And typically these are potentially going to be more popular than tokenized dollars because they're effectively tokenized dollars with interest. So instead of just holding $1, you can hold $1 that accrues 5% yield. That sounds pretty good. Next is tokenized commodities. Now there's become an influx of tokenized gold, silver, platinum, palladium, right? Inherently, these types of assets are expensive to transfer, are a pain to custody, and most people just want a tokenized form of them rather than having to hold the physical gold or hold the physical silver, and they're safe at home. Right? So they'll opt for a tokenized version. As alluded to previously, we talked about tokenized stocks. There's lots of private credit issued, and then it's even hard to even estimate the amount of tokenized real estate issued to date, but there's a bunch of different projects issuing tokenized real estate. However, let's talk about one important point related to all the different types of tokenized assets, and that's the promise of the issuer. Remember when we got 100 USDC earlier in the presentation? Well, let's say you're done with your USDC, you sent it all around, and now it's time to get your $100 back. How it should work is that you would send your $100 or your 100 USDC, right, that you held, and you send it back to the issuer. They were holding your cash in the bank the whole time, and they'd send you the money back. However, during that whole time that you were using the USDC, you are trusting the issuer that they're actually holding the underlying cash in the bank to back that USDC. So the point is that tokenization only works if the issuer is trustworthy and transparent. So that's the segue for us to go into the transparency and reporting challenges related to tokenized assets. Now, it's funny, most of the time when I bring up this topic of, hey, there is transparency challenge related to tokenized assets, a lot of people will say, well, just go look on the blockchain. It's publicly visible, right? Go on Etherscan, go on any of these blockchain explorers, go run your own node, and you can see the tokens yourself. Well, yeah, I understand that the tokens you can see, but what about the $100 in the bank that we can't see? What about the house that's tokenized that we can't see that's in the real world? What about the gold in the vault that's backing this tokenized gold product? None of that is viewable to the public, and you can't see it on blockchain. And oftentimes, most people think, well, somebody must be watching to make sure that these issuers are acting appropriately. Well, I'm fortunate to say that at this stage, laws and regulations related to governing digital assets are or scarce or inconsistent. If the rules are different jurisdictions, if they even exist at all. Some jurisdictions like New York, right, they have a reporting framework whereby the issuer of stablecoins needs to report monthly. But that's really about the only defined legislation in the US that relates to stablecoins. There's a couple more, here and there in a couple states, but largely there is not that much transparency for these tokenized assets. So the key point is most of these issuers, they don't have a regulatory obligation to provide transparency. Many, they can report on what they want. They may report distorted views of that information, right? Leave key important things out, or just not be transparent at all, right? And it's not against the law. There just is no law. So if we think about what can happen when trust in these issuers wanes, we've actually seen it in action over the years. This is an example of the USDT or the Tether chart back in 2018. There are worries that a sister entity related to Tether, right? There was a Bitfinex and Tether controversy, as it's referred to, that the sister entity was under reserved. It was a Bitcoin exchange. They got hacked and they were under reserved, and they were using Tether funds to make customers of the exchange whole. So under these concerns, there was a run on Tether, right? People were selling their Tether on the open market and essentially broke the peg. It broke the buck, if you will. One Tether, which is supposed to represent $1, was no longer valued. So this is what can happen if there's trust issues in these underlying assets, in these tokenized assets. You could have RWA runs. RWA stands for real world asset, and an RWA run is akin to a bank run, right? If people are worried that the bank doesn't have all the money, everyone's going to go to the bank that day and go try to withdraw all their cash. The same thing for a redeemable real-world asset, a tokenized asset. Everyone's going to take their digital representation and go to the issuer and say, hey, give me my money back. Give me my tokenized, or give me my gold out. Give me my real estate out. Give me my real world assets out. You take the digital representation. I want the real thing. Additionally, you can create market panics, and structural market issues can occur from these different types of events, because oftentimes assets are used as collateral for other positions. So for example, some people use digital assets, call it a tokenized piece of real estate. They might use that as collateral for a loan. Now, if your collateral loses half of its value or 2/3 of its value in one day, now your loan is going to be underwater and they're going to liquidate you. And it's going to have this waterfall impact of market turmoil, right? This is what happened in 2008. Once you have one failure, you think you have a receivable from a counterparty, but now you don't. It's worth $0, and now you're underwater to your friend down the street, right? And this daisy chain that occurred, and that's what can happen if these RWAs break the peg or they're not really backed with what they say they're. So, as we think about the big questions related to real-world assets, key thing to understand is, how does the public know that a tokenized asset is fully backed with like-kind assets, and how can we trust the issuer? These are the two key things to understand about tokenized assets, and it's what the public, regulators, and issuers should be working to understand and address. The good news is, though, is that with problems comes opportunities, and as auditors and accountants, we're in a great position to help solve some of these challenges related to tokenized assets and art. So, as we think about, if we think throughout history, auditors and accountants have been around for years, right? Almost 6,000, 7,000 years, starting from Babylon, right? Accountants and auditors were used to keep track of taxes and wheat held in granaries, as far back as 5000 BC on clay tablets. 1400 AD, Luca Pacioli created double entry accounting. There was professional organizations, and then digitization of accounting and audit in the 1990s. Auditors serve every industry now in the 2000s. And now with this new era, starting in 2009 with the creation of Bitcoin, auditors are playing catch up, but history has shown us that auditors adapt to the needs of the market that we serve. So who can provide this trust and a trustless system that blockchains are often referred to as? Well, the answer should be reputable auditors, right? This is what we've been doing for 5,000, 6,000 years, is presenting financial information to the public in a digestible, understandable, and accurate manner. Why is that the case? Well, because the trusted role of auditors isn't going away. It's just evolving, just like it always has. So let's dive into some of those opportunities of what you might be able to do today if you're diving into the space. The first thing is proof of reserves, or collateral reporting, as it's referred to. So this is an example of, not the whole report, of course, but the meat of a report that we actually issue for a stablecoin issuer issuing out of New York. They actually issue a yen-backed stablecoin. That's what this one is related to. You'll see that what we report on is the tokens in circulation, right? And the fair value of the redemption assets, the collateral held at the bank by the issuer on behalf of these token holders. You'll see that they have more redemption assets than G-Yen tokens in circulation for both days during the month. That's good. Good news. This type of reporting started in 2018. Initially, it wasn't in response to any regulatory considerations, but stablecoin issuers wanted to use transparency as a marketing and competitive advantage. So they started issuing these reports to gain and garner trust from the public, so they'd actually use their stablecoins. Since other jurisdictions, such as New York, as mentioned here, have started to make this a requirement. And this is for stablecoins. However, other jurisdictions, and for example, Texas in the United States, they have legislation that requires similar reporting for digital asset exchanges and custodians. So instead of just stablecoin dollars in the bank, you have to report on all the crypto assets that you're holding on behalf of your platform customers. So think of Coinbase, for example. They would have to report on all the digital assets that they're holding on behalf of their customers. As of right now, these reports are typically being issued under ATC 205 examination standards or ATC 215 agreed upon procedures standards. In New York, they require 205, but for the exchange proof of reserves, most of them, actually all of them, have been 215 to date, just because of the inherent complexity and the lack of standards and criteria to actually issue these reports under today. So if we think about this, right, this is very important to report on. We talked about those two sides of the equation. Well, it's pretty obvious what that tokenized or the token side is, right? You can see that on the blockchain, but this reporting is extremely important for the off-chain collateral or off-chain reserve side of the equation to back a tokenized asset, right? Now, today, the AICPA, the American Institute of Certified Public Accountants, they're working on criteria for stablecoins. I believe it's in public comment, or that period might have already be closed. But they're working on a standardized set of criteria for parameters to issue or to report on for stablecoin issuers. Next, they're moving on to other tokenized assets and exchanges and custodial reporting for other proof of reserve type of engagements. This hopefully will reduce the barrier to entry for many accounting firms and auditors because they'll have a defined set of criteria and some examples that they can follow. It's not just proof of reserves, right? And for auditors, there's other opportunities for those as it relates to tokenized assets. All of these issuers are usually just entities or companies like any other company where they will need accounting, tax, advisory services, right? But of course, with this, since they're digital asset companies and tokenization companies, they're going to have some unique challenges that they're going to need solving. There's going to be global tax consequences potentially for this borderless industry. There's billions of money flowing in, out, minting, redeeming, burning, the legal structuring, the tax structuring. There's a lot of complications with this type of business, and they're going to need expertise to help them be able to operate in a compliant manner. You, as if you were to dive into this space, with these unique challenges, if you were able to get the experience and solve these unique challenges, you'd be at a huge leg up, right, compared to all your other accountants and auditors in the marketplace, right? You'll have a unique skill set. So this is a great opportunity for all these just traditional services applied to this new type. The next opportunity is pretty novel and unique. It might take a little bit more explanation. The next opportunity, we call it on-chain reporting. And this is live today. It may seem far-fetched, but it is live for 3 firms out there. But what on-chain reporting opportunity is bringing trusted data on-chain. Now, we talked about the problem with off-chain data, right? No one can see it. And when just a reminder, what is off-chain data? Well, think about on-chain data are these tokens on a blockchain that you can see. You can go to an Explorer and see the balances and see the transactions. But off-chain data, such as bank data or real-world asset data, right? A token of a house or a car or a treasury balance at a brokerage, a bank balance at a bank, right? No one else can see this information. It's off-chain, right? You can't see it on a blockchain explorer. So the problem with this blockchain or this off-chain data is that not everyone can see it. However, just like we were providing transparency, providing attestation reporting, right, maybe on a monthly basis, maybe there's an opportunity for us to bring that off-chain data on-chain. What if auditors could be this trusted bridge of information, bringing that off-chain data on-chain, and now it can be used for smart contracts, it can be used for transparency measures, it can be used for insurance protocols once it's on these blockchains. Well, that's exactly what's happening today. There's 3 firms that are performing this service today. We are one of them. And how this works is that there is an issuer, right, with reserve assets. And what the auditor does is that we'll inspect account details with reserves and we'll integrate monitoring tools. So, for example, let's make this a little bit more tangible. We have a client, right, an issuer of a stablecoin. they hold all the reserves at a bank. Well, of course, we can prove that they own the bank. We can look at the data parameters of the banking details. We can aggregate data from different accounts if we need to. But what we can do is that we can hook and extract that information from the bank via API, and then monitor it, put parameters around it, and then we can expose it and publish it onto blockchains. And the crazy thing is that you can potentially do this as frequently as every 30 seconds, or maybe even more frequent, right? You can hook into this bank and expose this private information onto blockchains to make it more transparent. And that's exactly what's happening today. And the reason why we make sense to actually insert into this equation is because we can vet the data that's being published on chain. We can confirm ownership of the accounts. We can maintain the privacy of the issuer if we're consolidating a bunch of different bank details. We can conform the data into the desired reporting parameters, right? Think about, most of like an audit report, right? We conform the data to fit the reporting parameters. We can do the same thing here. And most importantly, or potentially most importantly, is that we can be an accountable party, right? That's the reason why audits exist in the first place, is that if a company issues their own financial statements, well, how do we know it's real? How do we know they're not lying? And who can we hold accountable to confirm, an independent party to confirm that that information is accurate? Well, that's what we can do in this instance as well. We can act as an independent intermediary to vet the data before it's published on chain and actually used by other parties. So what does that actually look like? Well, this is a live example of what you can find on the internet, right? We actually perform this service for a company called Stabler, and they issue a stablecoin UERR, right? It's a euro-backed stablecoin. And what we do is that we hook into their banks and serve it via API to an oracle called Chainlink. Chainlink is the leading oracle service provider out there today. And what they do is they actually publish the data on chain. So we feed them the data and they publish the data. And Chainlink and other oracle providers have been working closely with Swift, the BIS, all sorts of institutions to actually think about how to provide the necessary information to create a tokenized future. And this is a key component of that. So you'll see here, right, this answer. This is the answer that they're getting from our API that we vetted the data from and provided to this Oracle network provider who publishes on chain. You can see how frequently it updates. And we can see the data source and the type of the data reporter in this example. Right, so this is live today. There are 3 firms doing this today, but I foresee this being one of those opportunities for accountants as we think about 10, 20 years ahead. What is it going to look like in the age of automation and AI? Is it really going to be monthly reporting, or is it going to be annual reporting, or is it going to be more frequent reporting, right? I can get an Amazon shipment in 2 hours. I can get my groceries in an hour. What is it? Why does it take so long to publish this data when it's natively digital and can be reported on extremely frequently? So we think this is an inevitability that the reporting frequencies become smaller and smaller, especially as the world becomes more automated, more digital, and more akin to artificial intelligence. So what else? What other opportunities exist? Well, if you maybe don't run your own practice, or you're not at a firm, well, there's opportunities for all sorts of different parties, right? Opportunities for regulators, for accounting bodies, even college students to create reporting frameworks for different tokenized assets. Right now, there's huge gaps, huge holes for consistent reporting, to even have any framework for reporting. So we are seeing some regulators around the world start to create some frameworks, but they would obviously be better if they were influenced by those providing the transparency, like auditors and accountants. If I was a senior project and looking for a project that could have a real world impact, this is definitely an area that I'd be looking into. This is if I was an accounting body looking to make an impact. This is where I would look to solve some real world challenges, because this is an uncharted territory and it's just becoming more and more popular. Just to make real the types of considerations and challenges when dealing with tokenized assets and reporting frameworks is just think about a tokenized asset, right? You have a tokenized asset on a blockchain, and you have a real piece of real estate. You have a real house in the real world. What data points is the public or the potential purchasers of that token, what are they going to need to be able to make an informed decision of that tokenized asset? What are they going to need to know? They're going to need to know the address. Are they going to need to know the value? What about the condition of the house? What if what if the roof is damaged? What if there's a lien on the house? What if the piping is no good? Right? There's so many different characteristics that are possible, but we need to think about what are the actual characteristics that need to be reported on that can be useful, but also feasible to be able to make this industry of tokenized or this type of asset, tokenized assets, feasible, because there's so many different potential ways this could go, but there's so many challenges that we're going to have to solve. And I would say that as an industry and as a profession, we need to move quick. We are at the risk of losing these services to other technology firms. This is an example. This is not a CPA firm, right? They're a technology firm. They started out providing smart contract audit services, which our profession also lost out to. And now they're providing similar services like proof of reserves or collateral audits, but without standards, without oversight, and without 6,000 years of experience. So that's why we, as a profession, we need to act today to build standards, to work with the public, and need to understand this technology and the opportunities so that we can serve in the capacity that we have been for millennia, unless we want to get replaced by technology providers. However, as we looked at, the opportunities are bright, they're boundless, and they're for everyone. So I highly encourage you to look into this space, to learn more about this. And you can feel free to reach out. We do have more resources related to tokenized assets and how you would be able to get involved. If you want to get in contact with me, feel free. My name is Jeremy. Now, again, you can reach me via email. You can DM me on Twitter, or you can reach out to me on LinkedIn. We also have some blogs on our websites on the networkfirm.com and ledgerlens.io that you can check out that touch on these topics as well. That's all I have for you today, folks. Thank you so much for your time. Look forward to answering your questions, and have a good night. Thanks.